Good morning. Let's study PRXI. Starting by technical analysis, this is the long-term chart since 1994. Well, this was a very small cap erratic stock. You can see here it was at 7 cents here, and at 13 now. This is about, let me see here, 13 divided by 7 cents, 185-fold return. So you can see the potential around microcaps. The long-term trend is very, very bullish, as you can see. Let's see the short-term chart. The stock is reacting well here to the 50-day simple moving average support. It is somewhat above that. The 50 days is around 11.5 now, and the 200 days moving average stands around $8 now. So there can be a pullback here to support again, but no doubt the short-term trend is very bullish. Let's check the fundamentals now. Well, this is the share count over the years since 1997, when it was 16.2 million shares outstanding, and currently it is 28.7 million. And this gives me a market cap of $382 million, and it was just $1 million in 2002, as we've seen. The company has been diluting shareholders' value quite rapidly here in 2005, 06 and 07. I really don't like this. But on an historical basis, I have a base here of 2000, when the share count was 16.2 million, and since then to now we have a share count compound annual growth rate of 8.5%, and the market cap over the same period grew 73% on an average annual basis. So on my valuation model that we'll see next, I'll probably consider about 8% as a dilution factor going forward. Let's check the balance sheet. There's no long-term debt, and the current ratio is 8.34. When it is above 2, I see it as positive, so at 8 it is really positive. This balance sheet is very healthy. Look at this. Cash and marketable securities accounts for 57% of total current assets. So I don't see why the company has been diluting shareholders' value, since it doesn't have short-term liquidity problems, but perhaps that's because insiders don't own too many shares. I'll have to check that if the stock is interesting on a deeper analysis. As for revenues over the years and gross margin, well, revenues were 1.15 million in 1997 and grew to 9.64 million in 99. There was hope here of strong growth. Let's check the technical chart again to see that. Where is it? Let me see. Well, we're in 97 to 99. 97 to 90. Well, yes, you can see the stock rose from about less than $1 to about $4, and then it went back down because revenue started shrinking again to just 2.71 million in 2002. In 2006, fiscal 2006, there were 12.9 million, expected for 07, 29.8 million, and for 08, 61.4 million. So analysts are expecting very strong growth going forward. In fact, revenues are growing since 2004 at a 120% average annual pace, and gross margin has been 82% in 2007, and the price to sales ratio is very high at 12.8. So the revenues, the market cap is 12.8 times more than annual revenues. Here I'm considering 2007 numbers. Let's move on to profits, earnings per share and net profit margin. Well, history shows a quite erratic picture here. The company lost 40 cents in 2002, and it was right at its low. And then fundamentals started improving, and the company earned 19 cents in 2006 and is expected to earn 29 cents in 2007 fiscal. Let me check here how much they did for the first 9 months of the year. They did 15 cents per diluted common share, so 29 cents for the full year. Perhaps this is just a bit aggressive. And 61 cents expected for 08, so also very strong growth here. Net profit margin, I put here 25%. It has been 24.2% for the 9 months so far, and it was 40.8% in 2006. And for 08, I see 28.5% net profit margin expected by analysts. Price to earnings ratio, considering 2007 estimates, is 45, which seems just a bit high. As for my valuation model, let me see if I can explain you this well. This is it for the next 3 years. That is, this is the view I get for 2009 given the current fundamental trends. These yellow lines are known facts, and these orange lines are calculated automatically by the model. So I just have to figure out what to think of these 4 white lines here: the dilution factor, the revenue compound annual growth rate, the final net profit margin estimate, and the earnings per share multiple estimate. So what we have here, the initial share price is 13.05, as you know. The initial share count is the current number of shares outstanding, 28.65 million. Dilution factor is the historical dilution rate, and what I'm expecting for the future given history. 8% here, I have to put 1.08. This gives me a final share count for 2009 of 36.1 million, with the initial share count growing 8% a year for the next 3 years. Initial revenue, this is 2006 revenues, 12.9 million, and I expect them to grow 120% a year going forward, as they've been doing over the recent years, and that means a 2.2 number here for the revenue compound annual growth rate going forward. Final revenue, given this 120% average annual growth for the next 3 years, will be $137 million, and initial net profit margin is the one we had so far for the 9 months in the fiscal 2007, which is 24.17%. I expect long-term net profit margin of 25%. This gives me a final net income estimate of $34.3 million and earnings per share estimate of 95 cents for 2009. I put here earnings per share multiple estimate of 20, seems reasonable to me, 20 times earnings, and final estimated share price of $19.03, and this means a share price compound annual growth rate for the next 3 years of 13.4%, and this is not attractive to me since I look for at least 16%. For the stock to start returning 16% share price compound annual growth rate, I would have to buy it at 12.19. So perhaps I'll consider this stock again on a correction, but it would have to be really a big correction, because I don't like the way the share count has been rising, and it seems like a niche player, and I don't know if it will have such long-term growth prospects as it will have over the next 3 years. So I consider it not attractive. On a 1 to 10 scale, I give PRXI a 5 rating. Thank you. Bye.